Hopefully for you, this past year was very lucrative for your investments. However, this could also mean that you will owe even more taxes than usual. To put it simply, if you invest in a non-registered or taxable account and you realize a 10% gain on your investments last year, you will have to pay taxes on these gains. So do not worry, in our society, if you find a way to make money, the good people of the government will find a way to get a piece of the pie. My name is Langevin from Claret Asset Management, and today I'll be giving you a really quick overview of why a very good year for your investments might also mean having the privilege of paying slightly more taxes. Now, let me start by saying that we are not tax experts. We are portfolio managers here at Claret, and we believe that it's important for our clients to have a fairly good idea of what's going on with their investments, including the taxes payable on those. Of course, not all investments are created equal, nor are tax rates the same for all investment income. There are three main ways you can earn money on your investments: interest, dividends, and capital gains. Let's begin where it hurts the most: interest. So among the three I mentioned, this is where you will pay the most taxes, because interest income is fully taxed at a person's highest marginal tax rate. As an example, interest is earned from bonds or even GICs. If you hold a 5% bond, this bond will pay you $5 in interest every year. So if you earn a salary of $100,000 per year, then your marginal tax rate is roughly 45%. 45% of $5 is $2.25, which means you will have to pay $2.25 in taxes. Tax-wise, this is the least efficient form of investment income, which is why some of you might hold more fixed income securities in your registered accounts. Now, the second type is dividends. If you hold shares of one of the big 6 Canadian banks, for example, you are receiving dividends every quarter. In my opinion, it is way more complex than what it should be, but we do have eligible and non-eligible dividends. To keep things simple, dividends are effectively taxed at a lower rate than interest income, and the non-eligible dividend is taxed more than the eligible dividend after adjusting for gross up and tax credit. However, if that dividend were instead paid by a foreign company, like a company in the United States, it would be taxed at a higher rate, just like the interest revenue we just talked about. Finally, we have capital gains, which is taxed the least among the three. Here's a simple example. Say you buy one share of a company for $10 and you sell it afterwards for $15. You just made a capital gains of $5. Half of that gain is recognized as taxable income. If we look back at our salary of $100,000 per year from earlier, with a marginal tax rate of about 45%, that 45% is applied to 1/2 of your $5 capital gain. $5 divided by 2 is $2.50, and 45% of $2.50 is $1.13. A silver lining with a loss instead of a gain is that it can be used to reduce your taxable capital gains. Don't forget that if you hold a mutual fund or an ETF, an exchange-traded fund, they are ultimately a basket of securities. So the revenues and gains are still being paid to you. So those trusts can pay you the same interest, dividends, capital gains, or a combination of those through the distributions. They can also pay you as return of capital. Think of a return of capital just like a capital gain. So we will use the same example as earlier. Remember when you bought a share at $10? Let's imagine that this time you bought $10 worth of a mutual fund. Before you sold it at $15, the mutual fund returned $2 of capital back to you. So this reduces your cost from $10 to $8. When you do sell it at $15, you'll have made a capital gain of $7, and half of it will be taxed at 45%. So 45% of $3.50 is $1.57. The fun fact is that return of capital can actually make your adjusted cost base go to zero, and it can even be negative. Note that before it dips below zero, you only have to pay your capital gains when you sell the position. However, if it does reach negative $2, for example, you will have to pay taxes on those $2 as capital gains right away in your next tax filings, even if you have not sold your position yet. All of that may seem like a lot, but the good news is that all of these taxes can easily be avoided with the TFSA. And leveraging your TFSA, the RRSP, and the magic of compounding can set you up for a comfortable retirement. Just be sure to check with your tax accountant to determine the appropriate application of your tax rates for all of your income. Thanks for watching. For more investing tips, visit our website at claret.ca, and don't forget to hit the subscribe button.